The Responsibility of Investing is a podcast by the PRI, the world's largest global body on responsible investment, representing over $128 trillion in assets under management. Each episode features conversations with thought leaders and experts from around the world, exploring how sustainable factors are transforming the investment landscape. This series helps PRI signatories and the wider investment community navigate responsible investment with greater precision and confidence for the benefit of both investors and society.
Hello, and welcome to the Responsibility of Investing, the PRI's podcast. Today's program is about the climate-nature nexus and what it means for investors. My name is Fabian, and I'm the PRI's Chief Sustainable Systems Officer. We're joined today by Laura Bosch, Senior Engagement Specialist at Robeco and based in the Netherlands. And Laura is also a member of the Advisory Committee of the Spring Initiative, which is a PRI stewardship initiative for nature, addressing the systemic risks of biodiversity loss to protect the long-term interests of investors. And we're also joined by Graham Stock. Graham is Managing Director at RBC BlueBay Asset Management and is based in the UK. Graham's responsible for emerging market sovereign research, and he's also the co-chair of the Investor Policy Dialogue on Deforestation, which is an investor-led engagement initiative that aims to halt deforestation in the most vulnerable biomes of the world. Thank you both for joining. It's good to see you. COP30 in Brazil provides a great opportunity to consider links between climate and nature. Brazil, of course, is home to vast rainforests, clean water, as well as significant agriculture and forestry activities. And the climate COP in Brazil will contemplate our economic call on nature to sink carbon, as well as provide food, energy, materials, and livelihoods. Hopefully all without undermining the biodiversity that these systems depend on. Now let's start our conversation with a solid foundation and investor perspective on the climate-nature nexus. Graham, I'll come to you first. How are you thinking about the climate-nature nexus in your work?
Thank you, Nathan, and thank you for the invitation to take part. It's a pleasure to be here. We think about it very much in terms of risks to the portfolios. So we clearly have a fiduciary responsibility to our clients to make sure that their portfolios fit with their objectives. In terms of the climate, we monitor the carbon intensity of our portfolios, and obviously that requires some bottom-up work on what the carbon intensity of each issuer might be and how that fits together in the portfolio. And then in terms of nature, we think very much about a risk-based approach. So we have individual evaluations for every issuer where we look at environmental, social, and governance factors that might impact the performance of those credits. And remember here that we're talking about investing in sovereign bonds primarily in the team that I work for. And so with those bottom-up evaluations, we're looking at what the risks might be around nature, very much science-led. So what are the feedback loops from the risks to nature for the credit outlook for those names? So Brazil is a good example with PRI in person just ahead and COP30. And clearly the loss of forest in Brazil is a potential risk to future growth in the country through the impact it would have on rainfall patterns, yields, market access, etc. So that's a clear example of where nature feeds into potential credit risks.
Yeah, thanks, Graham. It's a great example. And I'm just curious, can you only do this kind of work in countries like Brazil, where the natural assets are so clearly core components of the economy, or is this something you do in several markets?
We do it everywhere, absolutely everywhere. But of course, there may be instances where the natural assets are less of a driver of the credit story. There's less risk for the country if they're primarily dependent on manufacturing or services. Then maybe there's less of a link into the broader macro. But in every case, we'll evaluate those risks and look at whether it's something that is a terminal risk for the credit, or is something that we can address through engagement and maybe the government can address through better policies.
Okay, fantastic. And because we're discussing this idea of climate and nature as a nexus, you introduced the idea of feedback loops, which is really interesting. Can you tell us a little bit about what you do on this?
Again, deforestation is a great example. Deforestation poses lots of challenges for nature, of course, your loss of ecosystem services that would impact on the broader economy. But also, particularly in a country the size of Brazil, continental scale, the loss of forest cover also has a climate impact locally, in terms of rainfall patterns, in terms of drought risk, in terms of the water supply for hydroelectric power, which is the main source of electricity generation in Brazil. So the link between nature and climate, even at the national level in Brazil, is very intense. And of course, there are global ramifications as well when you're talking about an ecosystem as significant as the Amazon.
So in a way, the interconnectedness you're discussing here is a much stronger idea than a nexus. They're part of the same system, these dynamics, really, aren't they, that you have to address?
Absolutely, we think so. And the same would apply to oceans, ocean health. Clearly, that's harder to attribute to individual countries. That's a global commons question. But absolutely, there are feedback loops between nature and climate, and that's how we would think about the risks.
Yeah, terrific. Thank you, Graham. Laura, over to you. How are you thinking about the climate-nature nexus?
Yeah, thank you so much, Nathan, for having us in the podcast today. So indeed, as Graham already mentioned, it is very important to understand that climate change is one of the 5 key drivers of biodiversity loss, while at the same time, the type of services that we get from ecosystems are also essential for climate mitigation and adaptation, such as provision of water and also regulation in temperature and rainfall patterns. So it's very important to understand that these 2 topics are very much interconnected. And that means that it does pose a systemic risk for the global economy, but also for our investment portfolios, which are translated both as transition and physical risks on the front of climate and nature issues. But at the same time, there are also quite some significant investment opportunities stemming from this relationship, meaning that if we're able to identify those companies that are transitioning towards a net zero economy or towards a way of producing their products in a way that it reverses nature laws in the next years, we can actually also tap into growth opportunities. And the same can be said to companies that are providing solutions to the market to tackle these climate and nature issues. So I think it's important to take that into account in the way that we assess our investment exposure to listed companies and also the way that we manage risks and opportunities across our portfolios. There has been a broader agreement within the sector that these 2 topics need to go hand in hand. And we've been seeing in the last couple of years increasing guidance on the relevance of the need to bring those 2 topics under the same umbrella. So, for example, the Net Zero Investment Framework, which is an investor guide that helps investors on how to set targets towards net zero and how to develop transition plans. Originally, it was more focused on climate, but in the last months, it has been integrating deforestation consideration as a key component of helping asset managers, asset owners to meet their net zero strategies. And we've also seen organizations like GFANZ to basically drive some discussions on how to include nature in voluntary draft guidance as a key element of net zero transition plans. So I think there is a clear agreement within industry players in the financial sector that these 2 topics need to be tackled jointly. And we also hear this type of request from our clients, asset owners, especially in Europe, UK, and Australia, where there is increasing interest on how to converge these 2 agendas in a strategic manner. And for that reason, what we've been doing from Robeco's perspective is to actually not only integrate a methodology on how to assess transition risks for both climate and nature in our investment process, and we'll cover that a bit later during the podcast. But more significantly, we've actually developed an updated version of our net zero roadmap, which will be published in November this year, also including nature-related targets under the same strategic plan. So that means that we have a very clear strategy on climate and nature that will be rolled out across the organization, which will basically define the way that we want to achieve net zero by 2050, and also it will maintain our goal to reduce our financed emissions by 50% by 2030. But it will also include a new component on setting nature targets and being able to understand where are the main impacts across our investment portfolios when it comes to nature degradation. So we're looking at topics like deforestation risks, water usage in water stress areas, and also hazardous waste levels that companies are producing as proxies of the different drivers on nature loss. And then by using this information, we're able to basically screen which are those companies that have the highest impact on those issues. And then we've developed a very comprehensive stewardship strategy to tackle those companies that are more severely impacting these issues, but not having sufficient risk management tools in place to manage those issues across their businesses. So by having this holistic approach on climate and nature targets underneath our broader net zero roadmap, that really helps us to really identify where the highest impacts are across our investment portfolios and be able to steer companies to manage those impacts in an effective way in the next years.
Yeah, that's fantastic, Laura. Thank you. So we'll come back to it in a moment, but the fact that you're thinking about these in such an integrated way, including with your target setting, I'm keen to dive in a moment in how you are dealing with the trade-offs or the implications of different targets and different scenarios across those natural assets and roles, if you like, for those ecosystem services. So we might come back to that in a moment. I just want to start with Graham, if that's okay, on this question of how you're applying your work in your asset class and in your portfolios. I think this approach of looking at future credit worthiness based on nature risks, it's not novel, but it's fairly new. It sounds like quite sophisticated work that you're doing. Can you just tell us a little bit more about how you're doing this in a portfolio sense and how it might influence some of your portfolio decisions?
Absolutely. It comes down to the materiality of the risks and a risk-based approach to portfolio construction. So we have individual evaluations for every issuer where we'll go through a range of topics that we think could be meaningful factors. And on the environment side, that would include things like water stress, protection of biodiversity at the marine and terrestrial level, protection of ecosystem services, and so on. And then we'll assess whether those are material for the credit in question, what the impacts might be going forward. So, for example, if water stress in a country like Mexico, which clearly is suffering water stress in large parts of the country, and there are businesses that depend on freshwater supplies, the brewing sector, for example. If the problem becomes too acute, then that's going to have a macroeconomic impact on economic growth, or could require expensive mitigation and adaptation efforts on the part of not just the companies involved, but the government as well. And in fact, we've just seen a new water strategy announced by the government of Mexico to try and address some of these concerns. So we're thinking about what the risks are, how likely they are to be mitigated, and what the feedback loops might be to different sectors of the real economy, because the real economy is the source of tax revenues, which in turn are the source of debt payments. So it all has to tie back to what the risks are for debt service capacity for those bonds that are in the portfolio. And then from a more top-down approach, clearly, because we're doing that work, because we're monitoring the carbon intensity of the portfolios, clients can also come to us and say, well, we have this objective. We want you to meet that in the mandate that you're managing for us. So that comes back to the point I was making about our fiduciary responsibility to our clients. If they want us to run the portfolio in a certain way with certain targets that fit maybe their net zero goals, then we can do that because of the tools that we've got in place in the portfolios.
Yeah, thanks, Graham. That's a great example.
Climate change is reshaping global financial markets, creating risks that no investor can afford to ignore. From extreme weather damaging physical assets to transition risks and evolving market expectations, climate is now central to decision-making. The PRI Academy's new course, Climate Risk for Investors, will equip you with the critical knowledge and tools to navigate these challenges and stay ahead in an increasingly complex investment landscape. Get in touch to find out more at priacademy@unpri.org.
Okay, so Laura, let's have a look at listed equities, because I think you've got some interesting approaches. So tell us a bit more how you're judging where companies are up to.
Yeah, so we have a similar approach both for listed equities and fixed income. And basically the way that we integrate climate and nature in our investment process. So we have like a bottom-up process which looks mainly at financial materiality. And then we integrate ESG related information in our investment analysis in the way that we assess an issuer. So for example, if we're looking at nature related risks for a chemical company, then we will be looking at water management strategies, the way that the company is disposing, for example, hazardous waste. And those are important elements to integrate in the way that we develop our financial valuations for the company in the long term. And we do that across all high impact sectors for climate and nature jointly. But at the same time, we also look from a top-down perspective. When we put together our portfolios, we try to also steer towards the preferences that our clients have on how much exposure they want to have to climate or nature-related transition opportunities and how to avoid those risks. So for that reason, a few years back, we started working on developing a forward-looking analytic tool, especially on climate, that helped us assess basically what is the transition readiness of a given company, considering the sector where it operates and also the decarbonization pathway that is expected for that sector to then meet the Paris Agreement goals. And we also factor into that assessment not only the current performance of the company on their climate efforts, but also like their forward-looking ambitions and how well these are aligned with what is expected from that sector. So we've developed that tool for climate transition analysis already a few years back. And this year, we actually launched a similar tool, but looking at biodiversity transition readiness. So what we do there is to look at those companies that especially are operating in high impact sectors when it comes to nature loss, and then trying to understand how they are reversing their negative impacts on the different drivers of nature loss. And for that, we look at guidance from TNFD and other tools to understand for which specific sector, what type of indicators and metrics we can assess to sort of compare companies within the same sector. And we also look at the future commitments that companies have around nature-related issues. So by having these two different tools in place, what we're able to do is to have basically a traffic light type of outcome that allows us to see every specific company in our portfolio, what is the degree of alignment that they have with the Paris Agreement goals, and also on the nature front, how well on track these companies are to reverse their impacts on nature in the next years. So we're basically able to understand what is the transition readiness of a given company, both on climate and on nature. And that information can be used for portfolio construction, so screening our portfolios towards prioritizing those leaders in these two fronts and tilting our allocations based on that. But it also helps us to prioritize our engagement work with those companies that we know that they are lagging on this transition journey, either on climate or on nature. And maybe going back to your question, Nathan, about the trade-offs, because that's an important one, on how do we actually balance those cases where we see a very positive impact on climate and companies leading the transition when it comes to decarbonizing, but at the same time having a negative impact on nature. And that's not an easy question to answer. It's not like there is a one-size-fits-all approach to sort of calibrate these trade-offs. But what we think is important is that we need to have like a clear picture of the impacts the companies have on both climate and nature, and then integrate that information when we construct our portfolio. So if we have a clear mandate from a client saying that they want to have a holistic investment solution, really tapping into like transition opportunities, both on climate and nature, then we will look into issuers that have a positive impact on both fronts. And just to give you an example, companies in the electric vehicle value chain are very important from a climate perspective because they are helping to decarbonize the transportation industry, which is associated to a large level of greenhouse gas emissions globally. So very positive impact from a climate perspective. But at the same time, there are certain part of that value chain, mainly on the mining, so upstream in the value chain, where there might be impacts on deforestation and land degradation linked to like nickel mining or mining other type of critical minerals that will hamper the overall positive story on climate because there will be a negative nature impact. So what we try to do is to have a view on how companies are managing their supply chain on the environmental side of things. So looking at deforestation risks, also water management, waste management, and then pick those companies that are showcasing like a better approach on those issues, and then having them as eligible companies for our portfolios that want to have like a balanced view on climate and nature risks and opportunities.
Thanks for dealing with the trade-offs. I wonder if, because you mentioned reversing negative impacts a couple of times, for our listeners, just thinking about the context of agriculture and forestry and land-based industries, how are you dealing with companies when sometimes reversing negative impacts means treating their assets quite differently? Whether it's forest assets or land assets for agriculture, and the idea of returning land and to support biodiversity and these kinds of issues. Have you got a good way of dealing with these questions in your approach?
That's an interesting one. So I guess bottom line, what we are asking companies to do is to be able to demonstrate that they can actually produce their goods in a sustainable manner and without having additional pressures on land use. And if that negative impact on deforestation has been taking place in the last years, then also having like appropriate risk management system to reverse that and avoid that when possible. So also following the mitigation hierarchy. So what we see there is like several tools and solutions that companies can implement, especially in the food and agri space. If we talk about land use change risks related to crops like soy or beef and cattle products, I think there are some interesting solutions out there for companies to implement and also work with their suppliers to implement at the beginning of the value chain, like, for example, regenerative agriculture techniques where cover crops are being used to improve soil health and also like carbon sequestration capacity of the land that is used to produce these crops. Other solutions like silvopasture, which is being also increasingly used for cattle ranching or agroforestry. And also more on the tech side of things, we see some solutions related to precision agriculture that can also be quite beneficial when it comes to tapping into that nexus between climate and nature. So, for example, there are very sophisticated machines being produced by large agri-machinery companies that help farmers to decrease the usage of agrochemical inputs in their production by using less fertilizers and less pesticides. And that has a clear impact on climate because producing these agrochemicals actually generates a lot of greenhouse gas emissions. But also from a nature perspective, by using less agrochemical inputs, you can also improve soil health and decrease like pollution on water or air. So there are quite some solutions available. It's just a matter of supporting companies and making sure that also the farmers have the right incentive to adopt those.
Yeah. Okay. They're great examples. Thanks for sharing your expertise there. All right. So something that I know is dear to both of you is engaging with your investees, because you're so prominent in the leading initiatives that are developing our approaches to engagement. So could you elaborate for us, Graham? Give us the arc of experience and learning and where you're headed with the IPDD.
Absolutely. Yeah, thank you, Nathan. So the IPDD is the Investor Policy Dialogue on Deforestation, which we launched just over 5 years ago in the summer of 2020, talking to the government of Brazil about the need to bring down deforestation rates there, particularly in the Amazon, but in other biomes as well. And it started fairly innocently. There were about 20 investors who wrote a letter to the Brazilian embassies around the world, drawing attention to the risks from the forest fires. There've been a couple of years of intense forest fire activity in the Amazon in particular. It made headlines around the world, raising concerns about that and drawing attention to the materiality for our portfolios. And as fixed income investors, we stood out on that list. Most of the other investors who signed were equity investors. And the government in Brazil noticed that and reached out to BlueBay and asked why we were raising this topic. And we quickly arranged a call with the central bank. The governor of the central bank at the time had taken an interest, had a call with him and made the case that we saw a credit risk from deforestation in Brazil and the threat to future growth at the macro level, export access if other countries started to ban products that were tainted by deforestation, which is indeed what we have seen. And again, the changing rainfall patterns and other feedback loops. And they were surprised, I think, that fixed income investors would be taking an interest in that topic, but were very willing to hear the arguments that we were making and quickly offered to set us up with other meetings with other parts of government. When we went back to the other signatories, as equity investors, they were quite surprised that anyone would have this kind of access to government in this way. But of course, as fixed income investors, we'd always talk to governments. We'd talk to the central bank about their monetary policy. We'd talk to the Treasury about their fiscal policies. And we've been doing it ever since we started off in our careers in fixed income investing. So it wasn't such a big leap to do the engaging. It was maybe a little bit of a deviation from the norm to engage on a topic like deforestation. But it got tremendous traction. We were talking, of course, at that time to the government of Jair Bolsonaro. Ideologically, they were not particularly sympathetic to the concerns around deforestation. But the fact that it was investors, and we quickly incorporated Brazilian investors into the group, investors raising these concerns meant that we did get a hearing and we were able to make our case. We quickly added another working group. So we started to engage with the government of Indonesia quite soon after. And then a couple of years later, added also a consumer countries working group to talk to the countries that import products that might be contaminated by deforestation. Because, of course, it's not just a challenge for the producer countries, it's also something that the consumer countries need to be thinking about. And it's gone from strength to strength. So we now have over 80 members from 23, 24 different countries with about $10 trillion of assets under management. And we continue to engage. Of course, in Brazil, the level of deforestation has come down. The government changed at the end of 2022, and the new government under Lula has a more coherent policy towards deforestation, and the rates have improved. But of course, there's no room for complacency, and we continue to engage in the hope, really, of making those improvements future-proof. We want to make sure that we don't see any backsliding if there's a future change of government. And that the rationale for looking after the forest is a holistic one that benefits the whole country, not just maybe vested interests. And we think we are making that case. We do perceive some change even from state level governments that maybe previously were more antagonistic towards the concept. So we think we've made progress, but there's no room for complacency.
Yeah, it is reassuring to hear the methodical, diligent approach that you're taking to this. Ultimately, I guess that's what governments and central banks need so that they can come to a sound footing, despite the political noise that they're dealing with. Have you had to deal with any other government transitions that have gone the other way from the example in Brazil?
No, not really. I would say that the policy stance in Indonesia has been more consistent. Where there is a challenge, of course, is that the federal government, in Brazil's case, doesn't call all the shots. It's a federal system. So you've got state level governments that have their own policies. And so we've also engaged with state level governments, encouraging them to improve transparency. And we have had setbacks. So there's a soy moratorium that had been in place for many years in Brazil and has been challenged repeatedly by some agribusiness members, but also some of the state governments have also moved against that, and so that's currently up in the air somewhat as to whether that will persist. It's been accused of, because it's a voluntary commitment not to produce soy on deforested land. It's been accused of being a collusive exercise, market abuse in a sense. We strongly refute that. It's a voluntary commitment to avoid deforested land and therefore preserve access to export markets. But that's an ongoing debate. It's gone to the courts. It's a political issue, and different states in Brazil take a different view on that.
Okay, much more work to do then. Much more engagement to be had with some sovereigns as well.
Responsible investment looks different for every organisation. That's why the PRI has teamed up with signatories to create Pathways, a new digital experience launching this November. Pathways offers tailored learning journeys to help you meet your investment and sustainability goals in a way that aligns with your organisation. Explore resources, best practices, and practical guidance across asset classes and sustainability themes such as climate change and human rights. You'll also be able to benchmark your progress against peers, all in one flexible, easy-to-navigate space. Visit pathways.unpri.org to learn more, including what's next for PRI reporting.
Laura, please tell us about your experiences in the collaborative initiatives and share some thoughts maybe on where these collaborative engagements are headed.
So we've seen an increase in the number of collaborative engagement that are focusing on nature and biodiversity laws in the last couple of years. So I'll focus on corporate engagements, given that we covered sovereign engagement earlier through the IPDD work. So we have a couple of very prominent collaborative platforms. So one is Nature Action 100, which basically aims to replicate the successful work that Climate Action 100 has done in the past, focusing on those 100 companies with the largest carbon footprint globally, and sort of enacting collaborative engagement with different investors to tackle these companies and accelerate their decarbonization strategies. So a similar approach has been taken on the context of nature laws. So this group has started its work already a couple of years ago, and we've seen the investor base also increasing over time. Companies tackled through this group are actually quite diverse in terms of sectors, because nature impacts are prominent in sectors from food and agri to materials to energy to also consumer discretionary names. So it's quite a diverse group of companies that are covered by the group. And the engagement expectations are pretty straightforward. It basically asks companies to have a clear ambition on how they are going to manage their impacts on nature laws, how they're going to integrate that in their corporate strategy, and how they will roll out an impact assessment to have a more detailed understanding on companies' impacts and dependencies on nature. So that means not only the negative footprint that companies have through their operations to, harm certain ecosystems by means of changing land use and deforesting land or polluting water, but also understanding the way in which companies depend on the different ecosystem services where they operate. Like you can think of utility companies and need vast amount of waters to generate energy, pharmaceutical companies and need genetic diversity to actually do R&D and find the new pharmaceutical products to bring to the market. So it's very important that companies understand those impacts and dependencies and translate those into concrete risks and opportunities for their business. And then it is also very much relevant that companies collaborate with industry peers and also with relevant stakeholders to make sure that the broader sector is moving towards that direction. And of course, the element of target setting is also an important one. So if companies identify severe negative impacts in their operations or supply chain, they should have a clear strategy on how they will reverse those issues. So that's the set of engagement expectations under Nature Action 100. They've also done a comprehensive company benchmark where all 100 companies under this group have been assessed against these investor expectations. And surprisingly enough, what we found out is that large majority of companies do have some sort of ambition in place around managing nature-related issues in their business. but the amount of companies that actually conduct an impact assessment or set targets to reverse those negative impacts is much, much lower globally. So there is plenty of room for engagement from institutional investors on these topics. And then there is, of course, the PRI Spring Initiative, which is another collaborative engagement group focusing also on the topic of nature loss, but it has a more targeted approach. So what we do through the Spring Group is to focus on land use change risks, so deforestation mainly related issues, in specific biomes where we see large levels of tropical forests, so mainly specific countries in South America and also Indonesia. And what we've done through the Spring Group is to also bring together a group of investors to engage with those companies that operate in those specific ecosystems that actually have severe risk exposure to deforestation issues in those locations. And there, the set of engagement expectations is a bit more narrow, focused on deforestation topics. So we want to understand how companies are managing their supply chain risks around deforestation risk exposures. We also want to understand what type of commitments companies have in place to reverse those deforestation risks across their business, and also have a time-bound commitment to eliminate deforestation risks from their operations and supply chain. And a very important component of Spring is also the focus on lobbying and political engagement. So we recognize that deforestation issues is not an issue that can be solved by a company alone or even like a sector alone. It also needs like a jurisdictional approach. So there needs to be a broad collaboration between companies operating in these sourcing areas that are exposed to deforestation risks, but they also need to have like the right support from policymakers to have the right incentives in place that disincentivize farmers to actually clear up land. So that also ties very closely to the work that IPDD is doing on the sovereign engagement with Brazil and Indonesia. So there are a lot of synergies between all these different collaborative engagements, and it's good to highlight that we're actually very well connected in the work that we do. So these different collaborative investor groups actually come together and share lessons learned through their engagement dialogues, either with sovereigns or with corporates. So then we can also align the investor expectations and make sure that we also catalyze our influence through the different collaborative groups that we represent.
So, Laura, thank you. I guess an assumption of our collaborative engagement programs are that they benefit both investors and the companies, ultimately, because you're trying to agree and understand how they'll transition their balance sheets and ultimately their income to you. Graham described a very constructive and almost curious approach from the sovereigns. How are the companies reacting to some of the things that you're asking for?
Some of them are actually surprised to hear that nature is becoming a material topic for investors. So they want to understand a bit better how we integrate this information in our investment process, what type of metrics we use to measure the overall performance of companies within the sector that they operate. So they are also quite keen to learn from us what are we looking for, basically, when it comes to managing nature-related risks and opportunities. So it ends up being many times like a two-way dialogue where companies not only share the work that they do, but we also give them very concrete feedback and guidance on tools that are available to start their journey on like TNFD reporting, for example, or give them a bit more clear picture on what type of efforts they should sort of prioritize in the broader sustainability strategy to then bring like meaningful information to the market that then investors can factor in the way that they assess these risks. So I guess most companies are actually keen to have this dialogue with us because they are also in the learning phase to improve their disclosures and their strategic thinking around nature.
Yeah, thank you. It's good to spend a moment talking about the benefits of collaborative engagement to companies. So it's good that they're taking this approach in the nature programs. Thank you. Okay, so let's cast our minds to COP30. Graham, what do you hope to see out of COP30 to further catalyse the investor action that you've been discussing today?
I think the most important development potentially out of COP30 will be the launch of the Tropical Forest Financing Facility, which is a potentially groundbreaking initiative to channel resources to tropical forest countries and create a permanent stream of income that rewards countries for protecting these critical biomes. It's very difficult to generate the bottom-up financing for these activities on a very disparate basis. It can happen, but it's difficult to do that or rely on that as a sole mechanism. And so creating some top-down government level incentive, and in fact some of the flows will also go to indigenous communities who are critical guardians of the forests around the world, is potentially a huge step forward. And Brazil has done some tremendous work laying the ground for this. It was first mooted a couple of years ago, but in the last 6 months or so, Brazil has been working hard on formalizing the proposal. They've published a number of concept notes. They've committed $1 billion of junior capital for the initiative, which is an important starting point. And we're hoping to see commitments from other countries to also contribute what was effectively the seed financing for the initiative. And then the idea is that will be leveraged many times over by using it to back an investment grade AAA issuance on the part of the facility, with the proceeds then being invested in emerging market sovereign bonds to generate a margin which can then be allocated to the forest countries. So it is very innovative. It relies on commitments from donor countries for sure, but I think once those are in place, the market can handle the rest. The market mechanisms can come into play. Ultimately, they're hoping to make it a $125 billion facility, which could generate $3 to $4 billion a year of flows to tropical forest countries. So again, that's game changing, and I think would be a big step forward. Of course, there are lots of other commitments we'd like to see, and it'll be a difficult COP for the hosts in lots of ways, logistically and as well as in terms of getting multi-country commitments. But I think if we did see progress on the TFFF, that would be a big step.
Yeah, this
forward.
is a big one. Let's face it. In a way, it breaks ground that I imagine many countries are hoping to follow on this type of format. Is that what your expectation is?
I think many other sectors will want to follow suit. So it needs to be a multilateral approach, and it would need to be that for any ecosystem. But absolutely, you can see potential for similar structures for the oceans, for coral reefs, for any worthy cause in that sense. And the collaborative nature would be a critical starting point. But it doesn't have to be 100% sign up from the international community. You just need committed donors at the initial sponsor level, and maybe 4 or 5 countries would be sufficient for that.
Yeah. If investors wanted to know more about this, what's the best place for them to find the information?
So the TFFF has a website where they've been posting the concept notes, so everyone can see what their thinking has been around that. I believe it's tffff.earth. People should search Tropical Forest Financing Facility, and there will be an official site that they can go to.
Okay, well, congratulations on the work. I know we'll all be watching this one very closely. Laura, what about you for COP30? What are you hoping for?
Good to mention that for TFFF, actually there has been a lot of involvement from the financial sector in providing feedback on the actual structure of the blended finance mechanism. So I've been positively surprised about all the different rounds of engagement that have happened in the last months, and how some of this feedback has really landed well and has been reflected in the latest concept note that it was released. So there is a clear commitment to make this TFFF instrument actually not only attractive for sovereigns and donors, but also for institutional investors to provide capital through this channel. So I think that's it can create a very important precedent on how to explore innovative financial mechanisms to combat not only nature loss, but also climate change. So we'll certainly monitor closely the developments during COP around TFFF. But I think, of course, another important topic on the agenda is the update of the national determined contributions of countries for 2035. So that's something that we're also closely monitoring, given that will set the scene to the level of ambition and the level of policy developments that will need to be implemented in the next years across the globe when it comes to climate change. And there will certainly be an increased pressure on companies on how they are decarbonizing and how they are contributing to their not only domestic NDCs, but also more globally to achieve the Paris Agreement. So I think there will be hopefully a ramp up on ambition and action during the next COP and the announcement of the updated NDCs. Where there will be this spillover effect towards companies on stepping up their efforts and also, fairly speaking, towards the financial sector to really highlight the way that we can contribute to meet these NDCs and help to allocate capital in a way that support these climate goals globally.
Thank you, Laura. Okay, well, we are coming to the end of our time. And I just want to thank you. In a way, it's been a masterclass on thinking about responsible investment. You talked about a risk approach. You talked about your assessment tools and ratings. You talked about target setting. You talked about engagement models. We even talked about finance instruments and public and private instruments and vehicles. And we even talked about scaling it into other natural assets. But of course, importantly, you linked these ideas of climate and nature, not so much as a nexus, but in a much stronger framework of reinforcing feedback loops and integral relationships between natural systems. And so I think this is really the key message here. And the sophistication of your approach has really helped to bring that to life. So thank you for that. Now, a question that we ask all of our guests as we come to the end, because our podcast is called The Responsibility of Investing. So to each of you, please, what do you think the responsibility is that investors face today? Graham, let's start with you.
I think it's absolutely critical to be mindful of the risks that are still posed by climate and nature loss for our portfolios, and making that clear to investors and also making it clear to issuers. So continuing that engagement, and it's a two-way flow, but we shouldn't shy away from that. Having said that, we should always make sure that our arguments are rooted in the materiality of those risks to the portfolios. So science-led, not making claims that we can't back up, and I think that way will help to close or narrow the gap between those who dismiss these concerns outright and those who are passionate about them, and hopefully get to a more sort of level-headed approach to addressing the challenges. It needs to be collaborative, as we've been saying, because that helps to build momentum behind the concerns, but always you're rooted again in the materiality of these issues for the portfolios that we're managing on behalf of our clients.
Thank you, Graham. Laura.
I think it's important that indeed we keep an eye on that dot on the horizon, that there is certainly a significant climate and nature risk that we are facing globally, and that we need to factor that in the way that we manage our portfolios. And of course, we've heard a lot of news developments, more short-term in terms of geopolitical tensions, also trade issues that are really deviating our attention to more pressing, imminent issues that we need to also reflect in the way that we manage our portfolios. But I think it's important for us to stay on course and keep looking at that dot on the horizon and really think along with our clients and our peers on how we can actually balance that approach on risk, return, and sustainability, where we can not only service our clients and help them meet their financial objectives, but also look in ways that we can actually also support the transition to a more resilient economy from a climate and nature perspective.
Thank you, Laura. Thank you to both of you. Thanks to Graham Stock, to Laura Bosch. Thank you, listeners. We hope you've enjoyed this podcast today, and we'll see you next time.